Welcome to Rich Tribe. I look around sometimes and it's just crazy to me. The middle class is literally trapped in this exhausting cycle of financial struggle, while the wealthy, we just quietly keep compounding our money year after year. Today, we're exposing the single most devastating psychological trap that totally paralyzes new investors. Because honestly, if you can conquer this one mental roadblock, this specific illusion your brain creates, you'll literally change your financial destiny forever. Okay, Richard, let's just get right into it, because from where the average person is sitting, this whole investing thing feels completely rigged. We're constantly told to get into the market, right? We save up our hard-earned cash, but then it seems like everyday people always end up buying at the absolute peak, panic selling at the absolute bottom, and basically losing their shirts. Why does this keep happening? Are the wealthy just manipulating the game against us?
Rachel, that's a totally fair question. It really does feel that way. But the truth? It's not a rigged game run by some shadowy elite. It's actually a hardwired glitch in our own human psychology. When it comes to money, we are literally our own worst enemies.
Let's move to part one, the deadly snakebite trap. All right, so what you're describing, that tragic cycle of buying high and selling low, it actually stems from a very specific behavioral finance blind spot. I call it the deadly snakebite trap. It is the silent killer of wealth, and honestly, it's the exact reason the average man stays average while the rich keep getting richer.
Okay, snakebite. Sounds a bit dramatic, Richard. What exactly is this effect?
Well, the snakebite effect is basically this intense psychological aversion to risk right after you suffer a severe financial loss. Think of it like a novice walking into a casino for the very first time. They place a bet, they lose everything, and boom, they feel completely snake-bitten. They convince themselves they're just inherently unlucky, the whole game is a scam, and they vow to absolutely never play again. In investing, this happens when a beginner puts money into stocks, sees a sudden drop, and yanks all their cash out in a total panic. They swear off the market forever, which absolutely guarantees they miss out on all future wealth. They permanently lock in that loss. But hold on, Richard. Let me push back on that for a second. If I put my money I literally worked 40 hours a week for, into the market and it crashes, staying out doesn't feel like a psychological glitch. It feels like basic survival logic. You touch a hot stove, you burn your hand, you don't touch it again. How is that a trap?
Which brings us to part two, anatomy of the snakebite.
I completely hear you, Rachel. And what you just said brilliantly illustrates why everyday survival logic is actually financial suicide. Let's look at the hard data. Take the 2008 global financial crisis. If we track an index like the Nifty 50, in January 2008, the market was hitting these massive highs. Herd mentality totally took over, and first-timers rushed in, driven purely by greed. Then, the subprime mortgage crisis hit. By December 2008, just 11 months later, the market had dropped an agonizing 60%.
Right, which is exactly why people run for the exits.
Exactly. They panicked. They let recency bias convince them it was all going to zero. They sold out of sheer terror and got snake-bitten. But here's the absolute tragedy of it all. Because they never went back in, they permanently missed the historic recovery. Look at this timeline. By January 2020, that same index didn't just recover. It skyrocketed to over 12,000 points. A massive rally. The people who let fear drive them stayed broke on the sidelines, while the wealthy? We held on, kept investing, and multiplied our fortunes. Okay, but let's be real here. Nobody wants to sit through a 60% drop watching their life savings evaporate on a screen. Surely, dodging the absolute worst days of a crash has to outweigh missing a few good recovery days, right? Isn't that just smart risk management?
Let's explore that in part three, the real price of fear.
Rachel, that is the exact myth that destroys the average person's wealth. Look at these numbers from a 20-year study from 1993 to 2013. If you just bought and held an index, you averaged a 9.22% annualized return. That builds serious wealth over time.
Wow. Wait, so if you tried to time the market and just missed the top 5 days, your return dropped to 7%?
It gets so much worse. If you missed just the top 40 best performing days over a 2-decade period, your return actually went negative. You literally lost money. And here is the profound secret the wealthy understand. The absolute best days in the stock market almost always happen right in the middle of terrifying economic panics. Historically, the top 20 market days happen right after the 1987 crash, during the 2008 crisis, and during the Great Depression. You mathematically cannot separate the worst days from the best days. If you dodge the drop, you murder your gains. So, trying to dodge the drops means you inevitably dodge the exact moments your wealth is actually supposed to grow.
Precisely. Warren Buffett hit the nail on the head when he said, The stock market is designed to transfer money from the active to the patient. Even the greatest investors in history find that market timing requires you to be right 80% of the time, if the pros are only right about 60% of the time. If billionaires don't even try to time the market, why on earth should the average person?
Okay, logically that makes sense. But Richard, how does a regular person actually fight their own natural instincts? We're talking about severe loss aversion here. Psychologically, losing $100 hurts twice as much as gaining $100 feels good. We are literally wired to panic. How do we override our own brains?
Well, that brings us to part 4, overcoming your own mind.
The secret is you have to build a system that saves you from yourself. The average investor relies entirely on emotion. They watch the news, check the portfolio every hour, fall victim to the herd, and then they panic sell. The wealthy investor, though, we rely on systems. We use dollar cost averaging, build automated habits, and focus on long-term asset allocation. We acknowledge the fear, sure, but we completely remove emotion from the actual execution of the strategy. Okay, I want that system. The average person needs that system. Give us the exact step-by-step playbook the wealthy use to automate this. How do we start doing this today?
Let's break it down in part 5, the Wealthy Investor Playbook.
Look, it's boring, it's quiet, but it literally creates millionaires. Here is the blueprint. Step 1, buy broad index funds. Forget trying to pick the next hot stock. Just buy a basket of hundreds of top companies so you own a piece of the whole economy. Step 2, automate dollar cost averaging, or DCA. This just means setting your account to invest a fixed amount, say $100, every single month, automatically, completely ignoring what the market is doing. Oh, I get it. So when the market is flying high, my $100 buys fewer shares, but when the market is crashing and everyone else is freaking out, my $100 automatically buys way more shares while they're on sale. Exactly. You turn the snakebite into an absolute advantage. Then, step 3, reinvest dividends. Use a drip program. Any cash these companies pay you goes right back into buying more shares. I like to call it dividend hyper-compounding. And finally, step 4, let compound interest work. Give it 20 or 30 years. That small monthly investment transforms into a massive corpus. That's the true, unglamorous secret of wealth. Now, before we reveal the final historical secret that proves why you must never bet against the market, I want to invite you to officially join our community. Subscribe to Rich Tribe channel, like, comment, and share this explainer. The more we share this, the more everyday people we can help break the cycle of poverty and build real generational wealth. Absolutely, everyone needs to hear this. All right, Richard, give us one final piece of perspective. For the person watching right now who is still just too terrified to invest their first $100 because they're scared of a crash, what do they need to understand to win the long game? That takes us to our final section, part 6, winning the long game. They really need to understand a concept the wealthy call time arbitrage. Check out this chart of the 1929 crash and the Great Depression. We're talking about the most catastrophic financial drop in modern history. People literally thought capitalism itself was ending. But look at the long-term trend line of both price and dividend growth. It recovered, and it marched relentlessly upward. Companies keep innovating, economies push forward, and markets ultimately rise. The wealthy use time to their advantage. We buy great assets, automate the process, sit back, and categorically refuse to panic. So I'm going to leave you with this really powerful question. Will you let a temporary snakebite paralyze your permanent wealth? Look, the market is always going to have downturns. There will always be scary headlines. The choice isn't whether you'll face fear. The choice is whether you'll let that fear keep you broke, or if you'll use the discipline of the wealthy to start building your financial legacy today. The game isn't rigged. You just needed the right playbook. And now you have it. Go out there and start building.